for agreeing to present once again. Let me just do a quick intro, Arthur, before you get into it. For those who aren't familiar with you, Arthur, Arthur has worked in the investment industry for more than 20 years. He holds a honors in Econ Economics, cum laude, that's from the University of Stellenbosch, and an MSc Financial Economics degree from the University of London. Arthur, it's wonderful to have you on board again, and thank you. We look forward to a great session.
Thank you, Mark. Hello, everybody. Thank you for your kind introduction. So we're going to talk currencies today. I'm just going to share a screen here with a few slides on it. And let's see if we can get that a full screen for you. So there we go. All right. So we're talking currencies. So when we talk currencies, of course, the problem that economists have is that we can't really predict the future. Everybody knows that. But what we do try and figure out is where things are misaligned and how that misalignment is likely to resolve itself over time. So while, currency outlooks come with the usual health warning that they cannot be guaranteed, we try and at least give you some food for thought and some information that's hopefully useful when you make your deliberations around currency outlooks. So today we talk about some hard currencies. Clearly, you start with the dollar. And then we'd just like to illustrate a few points by then looking at at some currencies on our continent, on the continent of Africa. But starting off with the dollar. So we know this currency has been strong for a sustained period of time over the past decade. So this is just the dollar in real terms on a weighted basis relative to a basket of currencies. And yeah, it's had previous peaks that have been high, but the previous peak before that was the early 2000s and then the early 1980s. So in the context of history, this has been quite a shift for the dollar over the last decade. Issue is, can it stay where it is? So there's been lots of arguments recently that the dollar is going to result is going to have quite a significant fall over the next few years, and that's because it's going to be moving away as reserve currency of the world and so on. I think calls on that score are quite premature. The issue is the dollar still has the liquidity premium. If you look at the alternatives, the question is, would investors want to hold them? So if you look at currency like the euro, there's always in the background that risk in the longer term of some disintegration risk. So, there's that issue for the euro as far as the renminbi goes in terms of China. So I do think that currency clearly is going to get used more and more for trade purposes, but you need full convertibility of the capital account rather. And so the natural alternatives for the dollar are not ready to fulfill that role. Doesn't mean the dollar hasn't become somewhat less significant as a share of total allocated foreign exchange reserves, but nonetheless, still at above 58%. It holds the liquidity premium globally and is far larger than any of its, in inverted commas, rivals. So I don't think this argument in the near term is going to hold sway as to a significant weakening of the dollar. There are lots of other arguments, for example, and the dollar tends to ignore those. For example, often trotted out that this large current account deficit, which the US has run for so many years, eventually will count against it. The way I look at it is I look at the right-hand chart there, so we can see the left-hand chart, that current account deficit quite large. The right-hand side shows, though, on a net basis, the US earns more on its foreign assets than it's paying on its foreign liabilities. And if that stays positive, the present value of all those positive future income streams is obviously very large. So this is not an argument that I've tended to use to argue that the dollar would weaken. And so that leaves one more important thing, I think, and that is and it's possibly something that has more near-term implications from a sort of in inverted commas cyclical perspective, but that's what's the monetary policy stance of the US. And we know that they've led the interest rate hiking cycle amongst DM. And we at this point also know that in terms of the outlook for growth in the US, it's significantly better than, for example, the euro area at this point. So we've already had a significant amount of tightening from the dollar. This chart everybody would be familiar with on the left-hand side is policy interest rate hikes, tightening more than the euro, the ECB, European Central Bank. The right-hand chart just shows how relatively tight that is compared to the real natural rate of interest. So it's the real interest rate adjusted for the real natural rate of interest. And we can see that all three of those large central banks have moved a long way. but the US particularly tight at this point. So if I look forward for me in the near term, I'm going to show you in a second. I think the dollar is heavily overvalued. Anybody who's been to the United States recently will attest to that in terms of the strength of our own currencies and the purchasing power of our own currencies relative to the dollar. But if one looks at the near term, you've got to ask what's really going to shift it. I would argue that in terms of the outlook for interest rates, obviously the clearly important thing here is the growth outlook. And at the moment, it is a lot better in the US than, for example, in the euro area. Also a lot better than for the UK, in my opinion. That doesn't mean we're not in for a significant slowdown in US economic activity. I've argued this for quite a while, but in the euro area at the moment, you're looking at more like recessionary type conditions, really. And so let's just consider the US. So if there's an argument that the US is going to slow down substantially, your question is, is it kind of a recession that matches what is likely to be a very weak outcome for the euro area, for example, or is it somewhat better than that? So there are different arguments here. On the one hand, you look at the left-hand chart here, it's just the leading indicator, looking at real variables in the US and a range of financial variables. And historically, when you've had this kind of a downturn in that indicator, it has been a very bad outcome for GDP. On the other hand, this is a somewhat different situation. We know about the excess household savings. Now, my argument has been that we're getting towards the point where that excess household savings, or what consumers are prepared to spend of that will be drawing to a close, the positive impact of it in consumption. And I've argued that the savings rate would actually rise, and that would start to weaken the US economy. But there is a good counter argument as to why growth could still inevitably hold up a bit better than expected, and that is we've at least had a positive bounce in productivity, which means that perhaps fairly reasonably decent jobs growth, and yes, it has begun to soften, but still fairly decent in the US, can coexist along with slightly higher wages, because you've got the productivity to compensate and keep unit labor costs lower, and therefore be more in line with the inflation target of the US. So yes, it's off a very weak base, this productivity bounce, so there is that caveat. But if it is sustained, then perhaps more like a soft landing in the US is likely, which puts it still in a better space, I would think, than both the euro area and the UK. So, the US may overall be slower, or expected to be slower at the very least, in cutting its policy interest rate. And of course, we can't guarantee that we might not get another one more rate hike out of the US. But generally, the point being that there is still that possibility in the US, and also, even if it were not to do that, then it's likely that it'll probably cut later than the other two central banks, although the market might be a little bit reticent to price in any interest rate cuts anytime soon in the UK. But on balance, because of that argument, I think that the dollar probably holds up in the near still. Does it strengthen, though? Well, I've struggled to buy into that, and the reason is it is an expensive currency at this point. So if I'm looking at whether it's against the euro here on this chart, you can see looking pretty expensive, and then also against pound sterling looking very expensive. I think of these two, perhaps some strength potentially against pound sterling. I mean, the issue there is very much, questions around housing market, impact on the economy, productivity, current account balance, all of those issues. Perhaps that still weighs on pound sterling, and perhaps a little bit more weakness there near term. But I think on balance, I wouldn't make too much. My view is that not too much change here. The dollar is expensive, but it sort of hangs around for a while until the US starts to cut interest rates, and possibly later than the other two central banks. So in terms of the rand, my view on the outlook here, and I've held this view for a fair period of time, is that on a medium-term outlook, I think that the rand could, under the right conditions, and I'll sketch those conditions in a second, under the right conditions, it could fare significantly better. So this is just in log form here, and all I've done is just a very simple regression with a few variables to try and explain the currency. And my argument has been for quite a while that given the shocks that the rand has had to endure over the last couple of years, that it's actually trading more or less where it should be trading. So what are those shocks? Well, first of all, we had a commodity bounce, but this year commodity export prices fell quite sharply, and that's always a negative for the currency. Secondly, of course, benchmarking of the US interest rate hikes, tightening US interest rate cycle, tighter global financial conditions, also an environment within which the rand normally doesn't fare particularly strongly, actually obviously adversely affected. And then locally, the growth outlook, which deteriorated through the course of this year, it has stabilized a bit now, but it's hardly exciting. And what we've seen, obviously, is electricity load shedding and the impact that that has had. And empirically, one can actually see that impact on the currency. So given those factors, we're not too surprised to see the rand trading where it is, especially since there have been other factors in the background as well, curbing capital inflows. And at this point, it's something of a problem for the South African economy. So we're running a current account, we're moving into current account deficit territory again. This is a 4-quarter moving average chart. And so we're moving into current account deficit territory, but this is the first time in many, many years that we've actually had a dearth of foreign capital inflows. So one can see when South Africa in the early 2000s began to gather momentum and economic reforms were underway, the strong capital inflows in the financial account that we had, and that's faded off, obviously accentuated by the pandemic, and there's been a recovery from that. But those capital flows are hardly strong, so it's not easy for us to run a large current account deficit without placing pressure on the currency. So we actually do need increased foreign capital inflows, and unfortunately, in an environment of geopolitical and geoeconomic fragmentation that is escalating, that becomes harder to do. And also other factors such as our Financial Action Task Force grey listing. So when we look at grey listing, we had to look around the world as to what happens to countries that are grey listed. So I guess one of the theories would be that when you get grey listed, you get less foreign capital inflows, which means the currency weakens, upward pressure on inflation, downward and upward pressure on inflation, higher interest rates, and lower, and therefore lower economic growth. That's sort of perhaps how hypothetically you'd expect things to work out. Now, we went through a range of grey listing case studies. I'm not going to take you through each one, and quite a lot of them on our continent. And we find that there's no consistent pattern, that you don't necessarily get all those things, except for one thing that often does come up, and that's the currency does weaken. It does tend to do that. And I'm sure everybody has also seen the work from Kiddo and Petzold at the IMF on grey listing and the impact that has on inflows. They came up with some fairly large numbers. It doesn't necessarily have to be this large, but the point being that leading up to a grey listing, you typically get capital outflows, and perhaps even for a time thereafter, as investors struggle to adapt and learn amongst all the uncertainty as to where the currency should really be trading and actually what is going on. And so we typically get overshoot and volatility. So if you add that into the mix, no surprise that the rand has been as weak as it has been. But my point, though, is that, again, in terms of valuation, this currency is heavily undervalued, in my opinion. And I can, on a 12 to 15, or sort of a medium-term view, I think it's reasonable to actually build an argument that if the US Federal Reserve does start cutting interest rates at some point next year, if electricity load shedding does ease off, and I think there's a significant possibility that it would do that. We, in fact, do have quite a significant improvement in electricity supply built into our outlook into next year, which does improve the potential growth rate, not by a lot, not exciting, but certainly better than the very low base we're at this year. And if commodity prices, if global growth, we understand that it'll slow probably, especially if the US slows, but if it holds up reasonable territory and we get stabilization of commodity prices and our terms of trade, then under those conditions, with the Reserve Bank also having raised interest rates and a disinflation trend beginning to set in South Africa, the next few months inflation may be up a little bit, the trend is down medium term in our forecast. Under those conditions, the rand could do significantly better. Of course, in the longer term, you have to get off the grey list, you have to attract capital flows, but I do think that it's not an unreasonable expectation that if those factors bear out as we expect, that you would get the improvement in the rand. Okay, so that's on the dollar and the hard currencies and the rand. On the rest of our continent, just want to look at a couple of examples just to illustrate some points. So we know that on our continent, one of the issues has been that, the US tightens monetary policy, global financial conditions tighten, you get the spillover. And we've seen that in so many currencies and so many interest rate cycles on our continent. But we've had an added pressure that's been developing as well. And the added pressure is very much related to fiscal policy. And the way that I see how this works is that when you have fiscal policy that is unsustainable, clearly unsustainable, and you end up, as in some cases, by having to restructure your debt, and you lose the confidence of investors and you lose capital inflows. And the risk there, of course, is that you have the restructuring, or that you have, for an extended period, potentially printing of money, weak exchange rate, high inflation. And so, of course, those are currencies that you don't want to be invested in. And I think we've seen quite a few of those cases on our continent. One of them is the relatively well-traded Kenyan shilling. And we can see the left-hand chart here. For years, we were quite comfortable to value the shilling, and we had argued for quite a while when it was overvalued that it was undervalued on a considering where inflation differentials had been over time. But then it began to weaken quite substantially and simply hasn't stopped. It just kept on going. And this is very much an indication of a fiscal policy that is unsustainable and needs urgent addressing. At the same time, we've seen that dearth of foreign capital inflows beginning to be reflected in foreign exchange reserves declining. A falling level of foreign exchange reserves never a good indicator for a currency. There has been a bit of stabilization of late, of course, with some official assistance, but nonetheless, that trend has been down, a little bit worrying. So we've seen the yield curve shift up. So this is about fiscal policy, in my view. If one looks at it, if you look at some auctions of late were undersubscribed, net issuance behind for local currency debt issuance, the fiscal deficit being revised higher for this year or larger for this year, and issuance at the short end of the yield curve, upward pressure on short-term interest rates. So it's very much about fiscal policy, but more specific than that, it's about external financing and a lack of foreign currency liquidity. So we've seen this on numerous countries in Africa, on our continent, and because in recent years there's been quite a push towards funding offshore in foreign currency, and of course under the global conditions that we've had, that has exposed a number of these. But just to illustrate the point, this from the IMF's recent review in mid-year under the EFF and ECF facility extended to Kenya, and one can see that these are just projections. Of course, these are numbers and they can change. They're based on a number of assumptions, but I think it gives a reasonable idea as to what the real problem is. So if we look at the gross financing requirement there, the top line, you can see it's made up of the current account deficit. And then, of course, something in the case of the current account deficit in Kenya is it's very dependent on agriculture exports. And so weather also has a very big impact, and soft commodity prices have a big impact. But it's been running a large current account deficit that's not expected to improve. Then we have the amortization of public sector debt and the sovereign bonds. There's that 2 billion rand euro bond that everybody's talking about. So its funding requirement is quite large. And at the same time, because it's been losing foreign exchange reserves and is getting to the point where there's serious question marks behind reserve adequacy, it has to, over the medium term, also look towards building reserves. So you actually need to add that back 2024, 25 as part of a financing requirement, which looks quite onerous. That's a lot of dollars that they need to fund there. So if you look at the funding sources as well, so FDI, you can probably have a reasonable idea of what that would be, but you're still assuming significant pickup there. And then public sector borrowing, planned public sector borrowing, and issuance of sovereign bonds is added. But very importantly, look at the significant pickup again assumed next year and in 2025 in private capital in net inflows. So you're assuming that Kenya does the right things on fiscal policy front, that it gets the official assistance that it needs, that it continues to grow firmly, and that it begins to work its way out of this fiscal hole and as its reserves start rebuilding, that then starts to, in inverted commas, crowd in other funding. So you've got that outlook in the medium term, and that's what you hope that happens. But it is a significant amount of capital that you need. And I think that is where the the uncertainty has come from in terms of Kenya. And the same thing is it has raised interest rates. It's not so much that it's got an inflation problem, hasn't raised it as much as the Fed funds rate, but that could be working through into currency weakness. So we might need to see further interest rate hikes before we can talk about hopefully stabilizing the currency. That's in my opinion. What would also help and could significantly change things is forex supply. If that were to improve, we know about IMF, World Bank syndicated loans that are being talked about, and some of those inflows coming in, and then also the possibility of Kenya seeking exceptional financing beyond their current quota, and also reports of public in the broader public sector, non-central government reprofiling of debt. So the number of things that could help improve the situation, both in terms of the amount of forex needed, and then also obviously the amount of forex then inflows in, especially from official sources. We'll have to wait and see how that pans out, and that could potentially could potentially help stabilize the currency. But I think that I would first need to see that foreign currency position improve quite materially, and some good leeway being made on fiscal consolidation before I become comfortable with the Kenyan shilling. So I actually don't have much change in the currency going forward, but I do highlight the downside risks. But okay, we'll see what those official flows amount to and whether they can actually change that outlook. Then another one that's had a very similar problem is Zambia, where we've also seen the currency trading particularly weakly. Not so much an inflation issue. You can see the left-hand chart there. Okay, it's still got double-digit inflation, which is not helpful. But inflation has come down sharply from where it is beginning to pick up now a little bit again. But it has very much been an issue around fiscal policy as well. And however, at least what we have seen though is yields coming down. So we know that we are in the process of trying to restructure those bonds in Zambia. The memorandum of understanding with official creditors, the official creditors committee that's been agreed to on October 23rd. Obviously, there needs to be follow through on that. But issuance of new dollar debt at more manageable coupons would obviously be particularly helpful. Yields are lower. There's reasonable demand. Most of that is local demand. So at least on fiscal policy front, we're moving in the right direction. Of course, the thing that would really accelerate things along would be if Zambia really follows through on its reform program that it's seeking to do with the IMF. So those are the usual things. It's establishing macroeconomic stability, looking at fiscal adjustment, improving governance, and all of those things. So also public sector investment, and then tackling fuel subsidies, and also adjusting electricity tariffs. So a whole range of things. If it were to do that, then this outlook could change significantly. I think of the countries that are restructuring, I think Zambia has got a fairly good chance of moving in the right direction, which would then alleviate things quite considerably. But you can see its currency's been on the back foot, and I think that it's offering. If you look at the long-term interest rates, it's offering nice real yield. You can see here just the 5-year bond, and the blue line there is CPI. So you're getting nice real yield. But again, the one problem that I do have is the dearth of foreign exchange reserves. So again, I'm holding back on getting too excited about the Zambian kwacha until such time as I can see this position improve, and that would require a lot more foreign participation. Of course, there is also the fact that it's a commodity producer, and so a lot depends on copper exports. Prices have been down, but at least relative to the last number of years, not down so much. So not particularly concerned about that at the moment, but nonetheless, now updated figures are hard to come by, but we know that last year non-resident holdings was about $2.6 billion, and reserves were barely enough to cover that. So that's the problem, is very crowded foreign investor positioning, limited supply of dollars from the Bank of Zambia. So similar to Kenya, where you've got poor liquidity, and you need to see the reserve position improve before you can become comfortable with the currency. But at least I think in terms of the outlook, I can see the building blocks beginning to take shape here, whereas there's still question marks behind what's going to happen in Kenya on the fiscal policy front. And then elsewhere, just looking at Botswana, another currency that I often look at. But this one's reasonably straightforward. So we know that the annual rate of crawl was adjusted this year to 1.51% downward crawl. And looking forward, you pretty much assume that over time that adjustment is made in line with projected inflation differentials. So and if you take that into account, then not much change on the pula over the next year. Probably similar depreciation to what we saw this year, although it's got ahead of itself a bit this year. If we are to remain in line with that trend through next year of the projected inflation differential, then maybe not too much change in the pula going forward. So relative stability, inflation's low. Of course, it does depend a lot on diamond exports to bolster its foreign exchange reserves, which have stabilized and begun to pick up. So I think that this year's agreement with De Beers should be particularly helpful as well. So don't think there's necessarily any pressures here that are going to change this arrangement anytime soon. So just relative stability in Botswana, and of course, from the perspective of fiscal policy and macroeconomic stability, they're much better shape than, for example, the two currencies we just looked at, the kwacha and the Kenyan shilling. So that's briefly my presentation, my main points of my presentation. So just the dollar still strong near term because of relative interest rates, firmer growth, higher for longer on interest rates potentially than the euro and UK. The Bank of England, I think investors may be a little bit reticent to price in rate cuts anytime soon. On the rand, I think it's undervalued. Have tried to sketch conditions under which it could in fact show significant improvement over the medium term. Of course, the one thing we have to mention is the election coming up next year. That could cause some significant wobbles near term, so maybe nothing too exciting before that's out the way. And then on the continent, I think the thing to pay careful attention to is fiscal policy, but especially countries that are dealing with dollar debt or foreign currency debt and have a dearth of foreign exchange reserves. They're still under pressure and they've got quite a bit of work to do before they come out from under that. But of course, there are also numerous economies on our continent where they're in pretty good shape, much better shape, relatively speaking, to put it that way. For example, Botswana, where you just expect the relative stability to continue. That's essentially my message. I don't know if there are any questions, Mark.
Thanks, Arthur. Arthur, just one question coming through. I know you did touch on it earlier. Can you just touch again on your forecast or your view on dollar and sterling and where you see that tracking?
Now it's probably, Mark, it's probably the most difficult one. I think longer term, the currency is cheap. The pound sterling is cheap. And on a longer term, I would put it at 140 to the dollar. But in the near term, it could see some further weakness potentially. And not a lot. But I just see it struggling to gain traction anytime soon. I know it's very cheap in my opinion. It's just got a lot against it at the moment. It's not a great functioning economy. It's got wage pressures that have been keeping inflation high, but real economic activity is not there. We know about the current account deficit issue. We know about productivity and investment issues. So you look at the medium-term growth prospects that just don't look great. And you've got this inflation pressure for the Bank of England to deal with. And as is the case for many developed market economies, you've got fiscal policy that at some point needs to be tightened, because I think this is one of the reasons why inflation has been stubborn or has been higher in emerging markets, developed economies. Of course, there's been the pandemic, and we know about the supply chain disruptions and so on. But really, loose fiscal policy, I think, has also been feeding in there. So it's got a lot of issues to deal with before, it's a currency that you would look to and say, gee, I want to own that. So it's very much a valuation argument. So I don't think it's going anywhere until, in my opinion, the US starts to cut interest rates. And the longer term on a valuation basis, it could be firmer, as I would think that the dollar would show some weakness over time eventually. So more question of the dollar softening because it's just so expensive, and over time one would expect it to weaken as opposed to a strong argument why the pound sterling is going to be as fundamentals that are going to drive it stronger.
And the euro, also some, with their slow growth rate, do you think that's going to put downward pressure on the euro versus the dollar?
Yes, I think euro near term, I'm not quite as negative on euro as I am on the situation in the UK. I think that a number of countries moving towards fiscal austerity next year or planning to do that. I think that the near term, unfortunately, they'll probably be in a recessionary type of environment, but that currency is pretty cheap at the moment, which does protect it to a degree. So maybe not too much change, maybe a little bit weaker over the near term, but not a lot. But strengthening over the long term. Our longer term target, and I'm sorry when I say long term, I can't put a date on it, but my fair value for it over time would be 120 to the dollar. But I don't think that the euro or the UK or the pound are going anywhere really until the US starts cutting interest rates and until this weak patch of growth in both the euro area and the UK bottom out. I think a combination of those the growth bottoming out in those two areas, euro area and UK, and US cutting interest rates would probably be a trigger in the medium term for them to start rising a bit more towards their fair values. But in the near term, they're on the back foot and may weaken a little bit more. But I think the more vulnerable one amongst, relatively speaking, would be the pound sterling.
So just to bring it a little bit closer to home, Zambia had a change in government last year, and there's a big reform agenda that President Ishilima is driving. Do you think that that's going to make a difference to, well, firstly to the currency, but to the broader region? There's big infrastructure projects that are underway, highway between Walvis Bay and Zambia. Do you think that that's going to make a difference as these reform agenda trickles down?
Well, I think if you implement this reform agenda, it's exactly what Zambia needs. It's focused on all the areas where there have been problems, and if you address those and you go through the restructuring, which is now seeming, it looks like it's underway. We've got the memorandum of understanding. It looks like we're moving. It looks like a combination of those two things should help stabilize the situation and also probably show the way for other countries. If I look at the countries that have similar problems to it, I would say Zambia is in my opinion, on the forefront of moving in the right direction quicker. And so it is a currency that I would like to be more positive on it. But in the near term, I'm somewhat cautious by just those dearth of foreign exchange reserves. But if it goes through this reform agenda, in itself, in my opinion, that should attract foreign capital. And once it starts doing that, it starts to work itself out of that difficult reserves position. And therefore, on a medium to longer term view, I think one could be quite positive on that currency, because it's also very undervalued at this point from a valuation perspective, in my opinion. But it's just the point, just being to just get yourself to that point where you feel comfortable that we are there, we're moving in that direction. Here come the capital flows. Yes, it's going to alleviate the foreign exchange control issue near term and get things going. But I do think cautiously optimistic, as they say.
I think that, as you and I discussed previously, the Brenthurst Foundation has got a similar view on Zambia, cautiously optimistic, particularly with the reform agenda and doing structural reforms going through that economy. Last question is regarding the ZAR versus the dollar. There's been some own goals scored in respect of the ZAR. What are you looking out for? You know, the election for South Africa is on or around May of next year. Obviously, the Namibian currency is also linked to the ZAR, so it's quite an important aspect to consider. What do you see as the big risks, downside risks, and potentially what are the easy ones for the ZAR in let's say the 6 to 12 month basis?
So the big downside risk is just the overall backdrop, geoeconomic and geopolitical fragmentation. I think we've moved away from where we were earlier this year, where at one point it looked like we might talk ourselves into a sanctions position, which I think that speak was overdone. I think that pessimism there was off the mark. But at the same time, it's clear that in this global environment that there is that risk if you misalign or are seen to be misaligning. That is a whole debate on its own. But I think that argument was overdone at the time. I'm not that concerned about that. I think that our stance is exactly the right one, as led by the president, and that we should be neutral. My opinion, I think that's the right way to go. But as far as those broader risks are concerned, the one that does worry me a little bit more for the longer term is we got to get off this grey list. And we are moving in the right direction. We are doing positive things. We've got the right laws in place now, but now it's about detection and prosecution. And we need to get that right so that over time we can shift off the grey list. But even that situation, I think relative to the initial expectation, it hasn't borne out as being an insurmountable problem at this point. So I'm not that concerned about those, but as a general backdrop, we do need to attract foreign capital inflows. And I would like to see us staying neutral on all these global issues. I think that stands us in good stead. We get capital from Euro area, the UK, the US. Most of our foreign liabilities are from those countries, but we're increasingly trading more with countries on our continent, with China as well, and the BRICS countries more broadly. So we've got economic interests everywhere, and I think we are best served by remaining neutral on these issues. So that then said, I think that what I'm looking for into next year, the election could cause a little bit of a wobble. I'm not as polls are polls, and they could be wrong, and I could be wrong. But I don't necessarily think that the ANC is going to lose as much ground as people expect. Normally, governments actually do a little bit better in general elections and local elections. And if it dips below 50, the concern has been about what coalitions would be formed. I think that there's different options there, and I'm not of the opinion that we're going to get a coalition that's especially damaging for South Africa, because I don't think the ANC will fall that far, and I think it can find coalition partners that are like-minded in terms of its policy approach. Of course, if I'm wrong and the ANC falls a long way, and it's difficult to put coalition together, that's a downside scenario. But I think once we've moved through the election, I think we can start looking forward to factors such as the Fed starting to cut interest rates. I think the SARB might stay on a hold a bit longer, but I think that interest rate differential will begin to work in our favor at that point. We've seen a big slide in commodity export prices. We expect some stabilization over the medium term, and that will always help the rand, all else equal. And I do think that it's quite reasonable to expect electricity supply to improve. So off the very weak base of this year, provided the global economy doesn't go into such a sharp downturn that we have renewed downlegs in commodity prices and global volatility, provided that doesn't happen, I think we can lift growth next year off this very low base. It's not going to be great, but I think relative to where we've been, all of those factors point to a significantly better outlook for South Africa, and then also for the currency as a result of that. So I have been more optimistic, I think, than the consensus for quite a long while on the rand. And from what I can see, sometimes difficult to tell exactly what the consensus is. But I remain constructive on the currency on a medium-term view on the rand.
You're going to allow me to put your feet to the fire and put a number to it, Arthur, let's say in July, September next year.
No, I'm not going to give you a number, but I'll tell you where I think fair value is for the currency. Now, in fair value, PPPs don't work for all currencies. So that's the first thing. But in the case of the rand against the dollar, it does tend to do quite well over the long term. It does tend to be a very good guide. And when you get towards 2 standard deviations away, where we are now, it tends to start moving. The next big move tends to be firmer, but it does take a while. It could be a year or two. The current fair value, I put it around 14 Rand 30 to 14 Rand 50 to the dollar. Of course, that fair value does drift upwards over time because our inflation rate's higher than the US. But I think that as a guide, on a 1 to 2 year view, moving in that, I don't think it necessarily get right down to 14, but what I'm trying to say is that it's got significant room for improvement on that medium term.
Take that. Thanks, Arthur. Arthur, we're fresh out of time, but as always, it's been fantastic. For those of you who have dialed in, thank you very much for joining us. There will be, if you do have any questions, you can flick an email to me. This session will also be on our YouTube page if you want to watch it again. But thank you very much, everyone, for joining. Once again, Arthur, much appreciated. Thank you.